The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Podcast, hosted in association with Frisby's Bulls and Bears, with me, Dominic Frisby. It is February the 11th, and I'm talking to Jordan Roy-Byrne, who goes under the name of Trends Man on the internet. He's a chartered market technician and the publisher and writer of the Daily Gold Premium, a publication which emphasizes market timing and stock selection for the sophisticated investor. And you can find more information on that at thedailygold.com. From 2010 to 2012, the Daily Gold Premium model portfolio was up 131% compared to GDX, which was up only 5%, and GDXJ, which was down 11%. And in 2012, the model portfolio was up 32%, making it arguably one of the top performing gold and silver stock newsletters. Jordan, thanks very much for coming on the show. That's a pretty impressive performance, given what happened in the broader markets last year. How did you achieve that?
Well, Dominic, thanks so much for having me on. It's a real pleasure. And it's interesting because when I started out my newsletter, well before that, when I started investing in this bull market in the companies, of course, my strength, my background is in technical analysis, because I believe you can just see so many relationships, so many trends, so many things that are going on if you know how to look at charts properly. But what's interesting is I realized at the end of 2011 that the reason my performance was mostly because of stock picking and not market timing. So that's something I really focus on in 2012, and that's something that I focused on back when I first started investing in this sector. I mean, of course, I look at so many charts every day. I love that, but for my own money, I was really focusing on picking, finding the best stocks and looking at fundamentals, and then kind of using technicals to get proper entry points. So in the last several years, I would attribute the vast majority of my success to picking the right stocks. I mean, going back to 2010, we were fortunate to have First Majestic Silver, which had that monstrous move. And then in 2011, I was pretty much out of silver. So even though I was still recommending some gold stocks when we began a cyclical bear market, I was out of mostly exploration and mostly silver stocks. So that kind of limited losses when the market was really weak. And going back to 2012, we were fortunate to one of the stocks that we were in was actually, I think it was the top performing gold stock on the TSX big board. And there was another one, I don't want to mention the name, but we got into it it's a producer, and we got into it about a month or two before I think it almost tripled in a couple of months. So those things really helped the performance. So it's interesting, coming at this originally being a technical guy, I realized that it's interesting because if you're looking at producers, I think what I like to call producers and growth-oriented companies, and also royalty companies, we had a couple of those in our portfolio over the last couple of years, so that obviously helped. I think when you're looking at those types of companies, you have to pick the best ones or the highest quality ones, and they're going to consistently rise with the bull market. So what I like to say is when you're focusing on the growth-oriented producers or the royalty companies, stock picking there is far more important than market timing. But when you're looking at non-producing companies, non-cash flow companies, exploration companies, development companies, obviously timing there is very important. Because if you pick something at the wrong time, then hold on to it for a year, 18 months, you can get killed, as we all know.
I've got about 3 questions that came into my mind that I wanted to ask you at once there. But just starting with the issue of market timing, I have an indicator that I use to follow the CDNX, and it's just a simple trend following method, and it doesn't get you in at the top and it doesn't get you out at the bottom, but it catches broader trends. And I've found, and it's just using moving average crosses, but I've found that, it's almost more important either be in this market or don't be in it. Because when you get one of those periods of decline, such as we saw last year and this year, and such as we saw in 2008, it almost doesn't matter what you own. You just don't want to be in the market. And then, once you've decided that it is a time to be in the market, once you have a buy signal, then, even some of these rotten dogs rise. So yeah, it's interesting. And I mean, in 2012, I found that one of the best performing sectors to be in has been the royalty companies.
Right. Yeah. Those were obviously. There's not that many royalty stocks, so I guess it doesn't hurt me to say the names. But Sandstorm was one. I was fortunate to find that.
Yeah.
I think in late 2010, and that was one obviously with Nolan Watson coming on board, and it had a decent chart. It had a decent trend, and I figured this is going to be a strong performer. That this looks like it could be a quality company, a quality position. And then Franco-Nevada was one. I think we bought that in the bottom. I think maybe there was a bottom in October, November. Yeah, maybe I think it was October 2011. We bought that one. And I remember early in 2012, like that was one of the only profitable positions we had. Like everything else was down, except Franco and probably Sandstorm too. So the royalty companies are definitely, those are ones that are very reliable, and those are ones that you have to buy on weakness. Those strong performing stocks, that's the time to get into those is when they're weak. For example, like right now, or perhaps we might, if we see a bottom in the sector in the next couple weeks, then the royalty companies, those are. We could be at a time where people could start to build positions in those and buy them at levels where they're not chasing them.
Okay, Jordan, I think we've got away with it so far, but we're not actually allowed to recommend individual stocks on the show, and we have to be kind of careful about mentioning individual companies. So, like I say, we've only said that certain companies have done well, so we're all right so far. But just be careful going forward with individual names. But just talking about now one little sector of the market that strikes me as particularly cheap. That's not to say it can't get cheaper. That is the development companies. So companies that are found an asset, they're developing it, they're drilling it out, they're moving towards building a mine. I guess these companies have been annihilated because they don't have any cash flow. And in fact, they're just sitting on a liability, which is that they've got to spend, X million dollars to get this thing into production. And nobody wants to lend them or give them X million dollars through the issuance of stock. So this sector of the junior development company is perhaps the cheapest and most beaten up sector of all.
Yes, I would absolutely agree with that. And I think in general, it's a very tough sector because I'm sure you and most of your listeners are aware of that development curve. I think Brent Cook was one of the first people to produce that chart where you see where the company makes a great discovery and then it makes that huge run. And again, this is coming back to the point where I said that timing is extremely important with buying these types of companies. And we're at a point right now where we're 12 years into this bull market. And so a lot of these development companies are probably at the bottom of that development curve where their deposits are maybe 1, 2, 3 years away from production. And so you're looking at, as far as long-term timing, I think they're at the right point to start taking a serious look at them. And I think the ones that have a lot of cash that we're able to finance at much higher prices, those are the ones, provided they have a deposit that looks like it can go into production and, it's in a good jurisdiction and all of that. I think those are really intriguing situations.
Very good. Now, I want to address an article that you wrote on February the 8th, so 2 or 3 days ago, and it was called The Truth on Gold Stocks versus Gold. And, why don't you outline the kind of the main themes of that article? It was not wildly bullish about gold stocks generally, and it was pretty dismissive about the performance of gold stocks in the 1970s relative to gold.
Yeah, it was. And what's interesting about the 70s is the gold stocks began a bull market in 1960, but gold didn't come free trading until 1971. So that ratio is real. You have to take, I guess, those first 11 years, you could say, take it with a grain of salt. But even after that, there was a little pop, I think, from 72 to 74. But even in the last 6 years of the bull market, from 1974 to 1980, that ratio trended down. So in that 6 years, the gold stocks underperformed gold. And what's so interesting is looking at this relationship. I mean, it doesn't make a huge amount of difference whether you're in a secular bull or a secular bear. I mean, as we know, Newmont is pretty much at the same price that it was in 1996. And it's hilarious because gold is up substantially since then. And you would think any gold company, any major gold company would have its share price much higher given the bull market in gold. And so what's basically, to get to the point, there's no track record of the large miners outperforming gold in a secular bull market. So all these people who keep pulling out their XAU versus gold charts and saying, "Oh, well, this means it's a buy. This means they're cheap." That might be true, looking over the next year, 18 months. But if we're, I mean, 4 or 5 years from today, I'm fairly certain that that XAU versus gold chart is going to be at an even lower point. And so, and the second point is basically, if you want to outperform gold, you have to be a stock picker, and you really need to look towards the junior producers, or what I said earlier, what I like to call growth-oriented producers. And you could also throw the royalty companies in there, and these are the types of companies, because they have growing cash flow, that are going to be consistently leveraged to gold. And what I found was, during the cyclical bull market, a basket of junior gold producers outperformed gold at a fairly nice clip. But once you got into a cyclical bear, those companies, they underperformed once again. So, I mean, how do we apply that going forward? I mean, not giving advice, but if you do believe a cyclical bull is going to start fairly soon, as I do, then a lot of these stocks will probably outperform gold pretty nicely. But once you get deeper into a cyclical bull, then that's when the stocks start to lose that relative strength, and gold outperforms. So you really, I mean, with the second point, you really have to be a stock picker and look for those companies that can grow their cash flow.
Yeah, if you look at the period coming out of the crash of 2008, gold stocks outperformed gold pretty much for all of 2009, right up to, and then we had a kind of fantastic 2010, and it kind of, in many ways, I know it kind of peaked in about December 2010 from my experience, although I think the CDNX actually peaked in the spring of 2011. But gold carried on going up until September 2011, when it hit that high of $1,920 an ounce. So that would suggest that, yeah, the one doesn't necessarily follow the other. And if you go back to actually the 1980s as well, in many ways the reverse happened. Gold made that huge peak in 1980 of $850, but the Huey actually went higher. It made 2 or 3 higher highs in the 1980s while gold was declining. So yeah, they don't necessarily correlate, and as counterintuitive as that may be. So you are saying you're pretty bullish, Jordan, about the gold stocks at the moment. You've made several pronouncements in your writing that you think we're nearing a low. Why do you think that?
Well, I'll try and be as brief as I can, but I think if you look since that peak that you alluded to that we saw in summer 2011, we've kind of seen a decoupling where conventional stocks and the equity markets have advanced very nicely. I don't have the percentage figures with me, but I mean, since that point, I think the S&P is up 25%, or it might be up 30%. And since the same point in time, the gold stocks are down about 30%, while the gold and silver are down about 10 to 15%. So what basically we've seen that decoupling, and what that means is we're going to have to start to see more problems in the economy and in the conventional markets. And I think it's going to take some time for those to happen. I think those will probably come to the surface later this year. But looking at the S&P 500, I think it can go up a little bit more, but we're basically nearing a point, looking at the sentiment indicators and also that technical resistance there close to 1600. Looking at those things, I think we're seeing the end of that trend. And so as far as the very short term, you have that very strong support there at 39.40 on GDX. And I mean, I do have a lower target of 35, which if you actually connect, if you use a closing price and you connect the bull market, or I should say the bear market low in 2000 with the low in 2008, it does come very close to 35. I actually did that with the Huey, and I think it's around 340 or so, and then I mirrored that to get 35 with the GDX. So I think we have very strong support there, and as we know, sentiment is very negative.
But I mean, if the S&P moves down from here, it's going to take gold stocks down with it, isn't it?
Actually, I disagree with that, because the S&P has moved up very well, as I said, in the last year and a half, and the gold stocks have actually gone down. So I'm not saying that every day or every week you look at, there's going to be a negative correlation. But what I'm looking for is the gold. I mean, if the gold stocks are the only sector right now that is quite oversold, and so we've seen either a decoupling or a reverse correlation. And if the S&P starts to run into trouble, I think you're going to see gold get a bid. And looking at the gold stocks, I think they're going to bounce from that 39.40 double bottom that we had in 2012. And there are some similarities between the 2004, 2005 low and the 2012 and potential 2013 low. There's not a whole lot of similarities, but there are a few similarities there. So, I mean, I realize it's a difficult call to make because things have been so terrible for a while, but I actually believe that if the S&P blows through and goes to new highs, I think that would be, in the very short term, I think that'd be negative for the gold stocks.
Okay, my kind of interpretation has been, when the S&P's been rising, when the broader markets have been rising, gold stocks have been flat or they've risen gently. But when the S&P's gone through a down period, gold stocks have been absolutely annihilated. So the general kind of direction has been the same. It's just the magnitudes that have been so different. Are you kind of looking for something where perhaps, say, the S&P's flat, gold stocks rise, and if the S&P falls, gold stocks, fall just a little bit? Perhaps a scenario like that.
Yeah. I mean, well, getting back to what I said before, I mean, I'm looking more at, if you just look over the last year and a half, you can see that that decoupling. It's a decoupling on a long-term scale. And what's interesting is if you look at the bull market in the 70s, we had something similar from 1972 all the way through 1977. It's very interesting that the gold stocks actually surged as the equity market was falling into a pretty bad bear market. And then when the recession was over and the equity market recovered, the gold stocks started trending down. But so that's kind of what I see. But and getting back to what you just said, I think we're setting up for maybe a 20% to 25% cyclical bear market in the S&P over the next year and a half to 2 years, in something that it's something that people are not going to say it's a cyclical bear market right away. Yeah. I think it's something that would gradually happen. And I think that's the best environment for gold, because if the economy remains strong and the equity market goes to new highs and holds it, which I don't think is going to happen, but if that did happen, I mean, then gold would be, everyone would be throwing in the towel on gold and the gold stocks. And, they would say, oh, well, it's, the secular bull market is over. So, I mean, that's why I believe we really need to see some pain there. Obviously not major pain, and that would be bad. But if we just kind of see that 20 to 25% decline over the next couple of years, I think that the gold stocks would be able to perform very well in that environment, because everything you look at, all these stock sectors have done so well. The sentiment on those is bullish, and then you have the gold stocks sitting all by themselves.
Yeah. Well, it's not just the golds; it's all junior resource stocks, isn't it? Really.
Right. And what those need is we obviously need to see gold break out, and I think the metals technically look really, really healthy. And I mean, what my forecast, which I mean could change, but I'm actually looking for a lot of consolidation. I mean, I am looking for the short-term rally into the spring, but I don't think we're going to break 1,800 on gold or 35 on silver, just because the shares are just so weak. I mean, they're going to start to, I think, at the end of the summer, you'll see the shares start to show some strength, and then at that point, it'll kind of telegraph this major breakout in both of the metals. And looking at that base on gold, I mean, I think it's actually more bullish if we continue to consolidate for another 6 months or so, because what you would see, provided gold breaks above 1,800, I mean, you would see a really explosive breakout that would have legs, well past 2,000. So to sum it up quickly, I think we see a short-term rally into the spring and then some more weakness, and then, possibly or potentially a breakout in the third quarter. Okay, very good. And I presume that applies to gold. I agree. I mean, gold is making a lovely long-term base. And what is the saying? The bigger the base, the greater the race, or something like that, I understand is the saying. But I have to say, I quite like gold here. And I think particularly, I really like gold against the pound and gold against the dollar. Yeah, it's maybe another month or so of sideways movement, and then I think the moving averages will be in a golden alignment. No, I absolutely agree. And actually, the most, well, I shouldn't say actually, but as you said, the most bullish consolidations are when you're consolidating in a tight base for a very long amount of time. And I wrote an article about that, looking at all the breakouts in gold. In the 2005 breakout, it wasn't a perfect consolidation, but the trading from 04 to 05 was very tight, and then you had a really explosive move. So I think we're going to see a breakout like that. Or I should say, if we do get the breakout, it's going to be like that and less like the other breakouts we've seen. Absolutely. And the other thing I like about long bases, is that you can make your guess about which direction the market's headed in next. And if you're wrong, it's pretty easy to manage risk. But anyway, Jordan, it's been a real pleasure talking to you. Thanks very much for coming on the show and for coming on at such short notice. You're actually on the west coast of the state, so I said at the beginning of the show this is February the 11th, but for you it's February the 10th, very late at night. But as we close, why don't you give out your website and some more information about how listeners can get hold of you? Listeners can go to thedailygold.com, and they also can email me at jordan@thedailygold.com. That's great stuff. Jordan Roy-Byrne, it's a real pleasure talking to you. And once again, that website is thedailygold.com. Thank you. Thanks so much for having me.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.